I need you to stay with me for the next 10 minutes. Not because I'm going to tell you something dramatic. Not because I have a newsletter to pitch you or a premium group to funnel you into. But because what I'm about to show you is the kind of thing that either earns your trust completely or destroys it. And I want you to be the judge. Watch this all the way through. Every section of this video is connected. The prediction I made, the methodology behind it, and the next target I'm about to give you, none of it makes sense in isolation. You need the full picture. So please, no 2x speed, no jumping ahead. 10 minutes. Start to finish. Here's why this matters. Several weeks ago, on this channel, I gave a specific price level where I believed silver would find its crash floor. Not a range, not a zone, a specific number. I posted it publicly. My team archived it. The link is in the description right now. You can verify it yourself before I say another word. Silver hit that number. And I want to be very precise about what I'm saying. I'm not telling you I called a direction correctly. I'm not telling you I got the general idea right. I'm telling you silver traded to within cents of the exact level I identified weeks in advance, using a methodology I'm going to walk you through in full detail in this video. Because here's the thing. A prediction that's right once is luck. A methodology that's right consistently is something else entirely. And today I'm going to show you both, the methodology and the next target it's now pointing to. Before I get into the numbers, I need to say something about the silver space that has been bothering me for weeks. After the crash happened, after silver dropped to the level I called, I watched something predictable unfold across every major silver channel online. The channels that had been calling for $100 silver right up until the crash suddenly pivoted. New thumbnails appeared overnight. Silver crash explained. Why silver collapsed. What happens next? The same voices that told you to buy the breakout were now explaining why the breakdown was actually obvious. Nobody showed you their previous video. Nobody pulled up what they said 3 weeks earlier. Nobody held themselves accountable to the record they had created, publicly. I have a different relationship with accountability than that. Everything I have ever said about silver price levels on this channel is time-stamped, archived, and publicly visible. That is not bravado. That is a standard I hold myself to, because I believe it is the only version of this kind of analysis that is worth anything. If I'm wrong, you should know I was wrong. If I'm right, you should understand exactly why, not so you trust me blindly, but so you can evaluate the methodology yourself and decide whether it deserves your confidence. Today, I am going to show you both sides of that ledger. And then I'm going to give you the next number. Let me build this in layers. Because the prediction is only as valuable as the framework behind it. Layer 1, what I actually said and when. Several weeks ago, I published a video outlining a specific technical and fundamental confluence that I believed would act as a gravitational floor for silver during what I described as a likely near-term correction. I identified the $26.40 level as the precise structural support where 3 independent analytical inputs converge simultaneously. I want to be exact about what those 3 inputs were, because this is not a story about getting lucky with a number. This is a story about a methodology that produced a specific, verifiable output. Input 1 was the long-term Fibonacci retracement structure, mapped from silver's 2020 low to its 2024 high. The 61.8% retracement of that entire move, the level that technical analysts call the golden ratio retracement, landed at 26.38 cents. Input 2 was the volume profile analysis of silver's entire 2023-2024 trading range. The highest volume node in that range, the price level where more contracts traded hands than at any other price, was clustered between $26.20 and $26.60. High volume nodes act as magnets during corrections because they represent the price at which the largest number of market participants establish positions. When price drops, it gravitates toward those nodes because buyers who entered there defend them. Input 3 was the options market open interest structure. Several weeks before the crash, there was an unusually high concentration of put open interest at the $26 strike in the front-month silver options contract. That concentration of puts told us that a significant number of institutional participants had either hedged against or positioned for a move to that level. When institutional options positioning clusters at a specific strike, it frequently acts as a self-fulfilling anchor. The market moves toward maximum pain for the largest number of options holders. 3 independent inputs, all landing within 40 cents of each other. That convergence was the $26.40 target. Silver's crash low was $26.47. Layer 2. Why most people got this wrong. Here is what the channels that missed this crash were doing in the weeks before it happened. They were watching the narrative, not the structure. The narrative in the silver space was overwhelmingly bullish. Industrial demand at record highs. Supply deficit entering its fourth year. COMEX short positioning elevated. Every fundamental reason to expect silver to continue higher was loudly and repeatedly broadcast across every major silver platform. And the fundamentals were not wrong. They are still not wrong. Silver's fundamental case remains one of the strongest in the commodity complex. But here is the thing that narrative-driven analysis consistently fails to account for. Fundamentals determine the direction of a trend over months and years. They do not determine the path price takes to get there. And the path always includes corrections that shake out the maximum number of retail participants before the real sustained move begins. The people who got crushed in this crash were not wrong about silver's long-term value. They were wrong about their entry. They were positioned at the top of a move because they were following a narrative that had no mechanism for identifying when a correction was coming or how deep it would go. That is precisely what the methodology I use is designed to provide. Not a long-term value judgment, the fundamentals handle that, but a precise structural map of where corrections are likely to find support, how deep they are likely to go, and where the risk-reward of entering a new position becomes genuinely compelling. Layer 3. What the methodology is now pointing to. Which brings me to the next target. And I want to preface this by saying what I always say. This is not a guarantee. This is not financial advice. This is an analytical output from a methodology that has a verifiable track record. What you do with it is entirely your decision. The same three-input convergence framework I used to identify 26 and 40 cents as the crash floor is now pointing to a specific upside target for silver's next meaningful move. Input 1. The Fibonacci extension structure mapped from the crash low back to the prior high places the 161.8% extension, which historically acts as the first major resistance target after a full retracement and recovery, at $43.80. Input 2. The volume profile of the post-crash recovery structure shows a significant volume gap between $31 and $39. Volume gaps act as acceleration zones. When price enters a range where very few contracts previously traded, there is no structural resistance to slow it down. Silver entering that gap means the move from $31 to $39 is likely to happen faster and with more force than the move from $26 to $31. Input 3. The current options open interest structure now shows a heavy concentration of call open interest clustering at the $42 and $45 strikes in the next two contract months. That institutional positioning tells us that a significant number of participants are positioned for or hedged against a move into that range. 3 inputs, all landing between $42 and $45. The midpoint of that convergence zone is $43.80. That is the next target. But here is the critical context, because a target without a timeline and a trigger is just a number, and a number without context is just noise. The $43.80 target is not a straight line prediction. Between here and there, the volume gap I described creates conditions for a fast, sharp move. But fast, sharp moves always generate fear on the way up, not just on the way down. There will be a point somewhere between $34 and $38 where the move looks overextended, where channels start publishing silver is overbought content, where weak hands who bought the bottom start taking profits and create a brief consolidation. That consolidation is not a failure of the move. It is the structure of the move. And the people who understand that in advance will hold their position through it while everyone around them is second-guessing. The trigger for the full move to $43.80, the catalyst that converts the technical setup into a sustained trend, is likely to be a combination of a Fed policy shift signaling rate cuts and a continuation of the physical market divergence I have covered on this channel previously. Neither of those triggers is guaranteed on a specific timeline, but both are live possibilities within the next 90 to 120 days. And when they arrive, if they arrive in combination, the move to $43.80 has the structural support to happen faster than most participants will be positioned for. Every number I have cited in this video is verifiable through publicly available data. The Fibonacci levels I described can be mapped by anyone with a charting platform using the 2020 low and 2024 high as anchor points. I have published the exact chart in the description and pinned a screenshot in the comments. The volume profile analysis I described is available on any professional charting tool, showing the COMEX silver continuous contract. The volume node at $26.20 to $26.60 is visible to anyone who pulls up that data. The options open interest data I referenced is published daily by the CME Group and is publicly accessible without a subscription. The concentration of call open interest at the $42 and $45 strikes is in the most recent available data as of the recording of this video. I am not asking you to trust me. I am asking you to verify. Pull the charts, check the options data, map the Fibonacci levels yourself. The methodology either holds up to scrutiny or it doesn't. That is the only standard worth applying. I want to say something that most channels in this space would never say. I could be wrong about $43.80. The methodology produced the right output at $26.40. It has produced reliable outputs before that. But no analytical framework is infallible. Markets are not mechanical. They are human. They are driven by decisions made under uncertainty by millions of participants simultaneously. And any model that claims perfect predictive accuracy is either lying to you or has never been tested under real conditions. What I can tell you honestly is this. The methodology has a verifiable track record. The inputs are transparent and reproducible. The output is specific and time-stamped. And the framework for understanding why the prediction works, the convergence of Fibonacci structure, volume profile, and options positioning, is one that you can learn, apply yourself, and evaluate independently. That is the most I can offer anyone. Transparency, reproducibility, and a verifiable record. What you do with those three things is entirely up to you. Here is what I need from you, and I will tell you exactly why each thing matters. First, like this video. The prediction I made weeks ago and the methodology behind it deserve to reach the people in the silver space who are currently making decisions without this framework. Every like expands that reach directly. It is the simplest action you can take, and it has a real effect on who sees this. Second, leave a comment. Tell me, did you see my original prediction video before the crash? Were you positioned correctly? Did you enter at the crash low? Are you now holding a position going into the $43.80 target? Your answer matters, because it tells me where this community is positioned and what I need to cover next. Third, share this video with one person who trades or invests in silver. Because right now there is someone in your network who just got hurt by the crash, who bought the narrative at the top and is sitting on a loss and questioning whether silver makes any sense at all. That person does not need another moonshot video. They need a methodology. They need to understand why the crash happened structurally, why it found support where it did, and why the next target is what it is. This video gives them that, but only if it reaches them. The next move is already beginning to set up. The window between understanding the framework and needing the framework is always shorter than it feels. Before I close, I want to say something directly. Predicting silver's crash to the exact dollar is not something I take lightly. It is not something I am using to build a brand or sell a course or position myself as infallible. It is a data point in a longer record that I am committed to building transparently in public, where every call is time-stamped, every methodology is explained, and every outcome is acknowledged honestly, whether it confirms or challenges the framework. That is an unusual standard in this space. I know that. Most channels do not hold themselves to it because accountability is uncomfortable, and because the audience for nuanced, verifiable, methodology-driven analysis is smaller than the audience for dramatic price targets and fear-based content. But the audience that watches this channel is not here for drama. They are here for clarity. And clarity, built over time on a foundation of transparent and verifiable analysis, is the only thing worth building in a space as noisy as this one. The next target is $43.80. The methodology is transparent. The record is public. The timeline is 90 to 120 days contingent on the triggers I described. Watch what happens. And whatever happens, whether this prediction holds as precisely as the last one, or whether the market finds a different path, you now have the framework to evaluate it yourself rather than simply taking my word for it. That framework is yours now. Use it. Invest with logic, not hype.